Right, good evening. First of all, thanks for coming, and it's great to see such a great turnout. Cadence Minerals. Well, Cadence Minerals is a partner and investor in the discovery and development of strategic minerals. So what are strategic minerals? Those are the minerals that power your mobile phone, lithium, cobalt, nickel, and power electric vehicles, and power basically most of modern technology today. Now, I think a lot of the time, you go through this and you want to see a pile load of resources, what we've invested in, and returns. But I'm just going to slightly flip it on its edge here and really talk about and hopefully provide you with some ideas, a bit of background and education around the electric vehicle market, the battery market, and critically for us, the shortfall in lithium carbonate that we're going to see. And I'm talking about the race against time. What we're seeing now is that the speed of penetration of electric vehicles is rapid. It is not a linear form of penetration. It's not the iPhone 7 to the iPhone 6 where it slowly gets there. It is the cell phone to the landline. It is a massive change. It's what we call disruptive technology. And like many projects, when you're talking about big infrastructure projects, which you're talking about, which the demand that this requires is a lot of lithium. And that in itself takes time. And that uptake is often quite linear. And I just took that off the internet, and it's, if you know Back to the Future 2, they're definitely waiting for the lithium to arrive here. So let's, I talk about disruptive technology. I talk about what it's going to be, but we have to look in history a bit. We have to understand what people used to think and maybe see it from their eyes, because often disruptive technology is obvious in hindsight. So this is a quote from Horace Rackham, who basically said that cars are a fad. And when you look, and this was around about 1903, and when you look at what he saw around him, this is Easter Day Parade, 1903, and everything there, bar that little red circle, is a horse-drawn carriage. So it's not unreasonable for the guy to think, cars are really just an iteration. They're just the iPhone 7 to the iPhone 6. They're the next one to move along. But lo and behold, 10 years later, spot the horse-drawn carriage. In fact, I think it's just there. Very poor resolution, but it's there. That is disruptive technology. It completely changes the way we move or the way that we do something. Give you something else. This is interesting. This is color TV. Basically, 20th Century Fox, CEO of 20th Century Fox just went, why is anyone going to go and watch a small little plywood box which has some movies being put onto it when they could come to the cinema and see this amazing experience with popcorn and all the rest of it? Color TVs entered in the market in 1960. 15 years later, they had penetrated the market by 85%. 15 years, they've gone from 0 to 85% of the people in the US having a color TV. That's disruption. And why is it disruption? Well, it's the cost curve, and we'll go through that. It's about the cost curve and that getting cheaper. It's also about the meeting of several technologies. What was unique about the color TV, or TVs in general? It combined the ability to watch programs that you would see maybe at the cinema, and also the transmission of that information onto and into the TV, and the ability to choose what the hell you were going to watch rather than being dictated to by 20th Century Fox. So the question is the electric vehicle a disruptive technology? This is from BlackRock, and it's interesting. It's basically looked at all the disruptive technologies and how quickly they penetrate. And I think you can see the color TV there rapidly. The car took a bit longer. There was a Second World War there. That probably affected it. But as you can see, as you move along here, these get really rapid and very steep. So not only are we seeing that these disruptive technologies have this S-curve shape. There's a long lead time, and then it rockets up, and then it's there. It's pervasive. It's the new market. So there's lots of models for disruptive technologies, lots of people talking about it, and I'm not going to claim that I'm an expert, but There's this guy called Tony Sieber who's done it, and he's been looking at it from everything back from the Gutenberg Bible all the way today, and he's sort of got this model together. And the model is what we said beforehand, the technology cost curve, technology convergence, and business model innovation. I'm going to focus on the first two in terms of electric vehicles. So, do electric vehicles fit into this? Well, let's look at battery cost curves. Batteries on their own have been powering our mobile phones and our laptops for a very long time. And if we actually look back here, even further back, that'd be about the cost per kilowatt hour. How much does it cost to have that kilowatt hour in your pocket? And if you go back here, it was about 3,000. And as you can see, and this is another reason why sometimes experts forecast for all these blue bits here. The actual leaders in innovation were here. This is the Teslas, this is the Nissans. They're producing the battery with the lowest cost curve. And we're seeing this cost curve improve on a logarithmic basis. So we'll probably actually see around here, Tesla probably already hit it. By the time they get their gigafactory in place, they will have about $150 a kilowatt hour. Again, look at the timeline. In the space of 10 years, we've gone from somewhere in the region of, let's call it 1,400 to 150, a 10 times improvement in the cost and the same capabilities, efficiencies. So there is a real cost curve occurring there. And then we look at convergence in electric vehicles. What's moving together in electric vehicles? Surely the electric vehicle is just another version. It's just like, not diesel, not petrol, but something else. It's just the same car doing the same thing. But when you start looking at the components within it, you start to see big savings. And I'll tell you what they are. There's a 5x saving on one of them. There's a 10x saving on one of them, and there's a 10x saving on the other one. That's a huge saving in cost base. Electric motors, they're much more efficient. Basically, you put petrol into your car, yes, it's much more energy dense than lithium, but 20% of it, 80% of it goes up in smoke, heat, and the rest of it. Electric motors are 95% efficient. But we've seen electric motors forever. You've had them in remote control cars. I used to have one. They were great, accelerated amazingly, but that never got combined. But it was when we had the ability to have the energy density that we see and the cost of the battery that we're allowed to get that combination gave us electric vehicles are much cheaper to charge. I did this on my own car, making my own assessment, buying an electric vehicle, and the difference is, just to charge it, is massive. And then this was really interesting. They're cheaper to maintain, about 10 times cheaper to maintain, because there's nothing in them. There's only 20 parts. UBS took, and UBS was one of the analysts, that what they decided to do is they saw this as so important that they took a Chevy Volt, one of the $35,000 cars, took it apart, assessed all of the aspects of it, and basically said that right now, today, it's in Europe certainly, and where the subsidies are there at the moment, it's worth just buying an electric vehicle comparative to a normal petrol or diesel vehicle. So with all that, the convergence, the cost curve, we're seeing that the proposal here is a disruptive technology. And I'm going to take, again, Tony Sieber. He's basically, the EV forecast will be from other sources. But using that model, he just showed that effectively by 2022, that's when the average low-end cost car is, but worth buying an EV car, it's going to cost the same amount as the low-end Ford Fiesta, 10,000, 15,000 quid. And in fact, I think he was saying by 2025, there is no point in having anything else but electric vehicle. Now think about those penetration rates. Remember the S-curves. And let's look at what people say. Citibank, that's about a year old, didn't forecast much past 2020. I think they were worried about where they might go, really. Liberian, very linear. Really haven't got the cost curve here. I mean, surely if this is S-curve, we are going to see they're really underestimating the potential here. Morningstar, again, they were one of the more bullish guys, but still, we're talking about penetration rates by 2025, if you really want to look at S-curves, of an excess of 80%. But these are penetration rates of 4 or 5%. Then UBS. These are guys who took apart the car. And this is their bullish case. That's 23% penetration of electric vehicles, of new car sales. So taking that, which even if you look at some of that S-curve theory and how that works, the reality is that that could be much quicker and much faster. But for the sake of conservatism and the sake of using data that someone's taken apart a car, we will use that figure there. So how does that affect lithium carbonate? Lithium carbonate is the compound that goes in the battery. The requirement, if you have an electric vehicle, you're going to need lithium carbonate in it. And these are our own forecasts. And we've used the Morning Star, not the most conservative, but not the most adventurous. And we can see these are current uses. It's used in ceramics, it's used in glasses, it's used in batteries for your mobile phones. These are pretty nominal growths, sort of 3-4%. The reality is electric vehicles represent the biggest growth here. They represent 900,000. This is a market going from 200,000 tons of lithium carbonate a year to 900,000 tons in the space of less than 10 years. And that is on the more conservative forecast of EV penetration. So, of course, we now have said that this is now an exponential curve. Whether it occurs here or a bit further along, it's exponential. So is there enough lithium around the world? Simple answer is yeah. I mean, it's the 17th most common element, so there's going to be plenty. There's 14 million tons of reserves. If those who don't know geosciences, reserves are economically mineable at this point in time. And there are plenty of resources. It's all coming out of brines in Chile, and more recently, hard rocks, spodumene here. But, that's a couple 100,000 tons. Where's the rest going to come from? New projects. I'm just going to ask a question here, and it's a rhetorical one because there's hundreds of lithium exploration companies out there. It's hard to identify the ones that are going to make it or not. There's technical risks, there's market risk, there is political risks. How many of them will come to production? Well, we all know it's probably not all of them. But this is a statistics taken out of exploration, a fairly well-known piece of paper that effectively reviewed about 2,000 exploration projects across the world in the 2000s and looked at the probability of an exploration project coming to production. 0.3%. That's greenfield. So some of these are not listed. That's early stage when you go out there looking in the middle of nowhere. So finding a major, it's not world-class, a major economic deposit of any form is a risky business. So this is where we come in. We try and identify projects, taking the expertise that we have, an understanding of the lithium industry, we've been involved in it since 2013, to identify assets that we try and narrow that probability as much as possible that will come to production. And as an investment company, we can exit and enter those as we feel. And so what I wanted to show here was taking that risk, what's the demand curve going to be? So I've looked, this is what we're going to see from So this is, as you can see, I've risked it. Advanced exploration, 10% make it. Let's just make that, we've done our own methodologies and feedback loops. Under current production, this is the increase of current production. That is definitely happening. There's a very high chance of that occurring. Those that don't know geoscience, feasibility projects. These are projects that got about 10 to 15% accuracy, but not all of them come to production. Pre-feasibility projects, again, a bit higher risk. And lastly, those that are under construction, they're the second most likely to come into this. This is sort of 95, 99%. This is around 90% probability of coming into production on time. Now let's look at that demand curve on top of it. So we can see there are very clear gaps here. There's probably a bit of oversupply here, but maybe I've got my forecasts wrong, and in fact those slip out, that production curve slips out there. But one thing that we can see is that production is definitely not a logarithmic scale. Demand is going to be. So there are opportunities for people like Cadence, for people like you, if you want to spend the time and effort in identifying assets that have got the potential to move from that probability to that probability. And this is probably a bit of extra that I put in, and it's really what we call the development funnel. When we look at copper and lithium assets, historically, when you look at, this is from on the stock exchanges. This was in 2013 when copper was, and you can see a lot were in early exploration, only a small amount of advanced exploration, pre-feasibility. Once you're there, it's got very high probability that you'll get to development. And lithium is not as advanced, so there is some idiosyncrasies here. And the reason why we've got that there is there was a real lithium push in 2006. So a lot of these projects that have been sitting dormant for a while over the last 2 or 3 years have moved up. So you can see for us, there is a favourable S&D curve for investment. The exploration space is underdeveloped. So what I mean by that is that because lithium is finding a new use, or not a new use, but a use that is going to be exponentially growing, finding new assets, people really haven't been looking for them. So the big assets, the big ones, the world class, like Greenbushes, have been discovered. The large assets, there's still potential to find those. And the small assets that, let's say, are still economic, there's definitely potential to find those. So there's plenty of investment opportunities that you just have to understand your exploration space, you have to understand the technical challenges, the legal challenges, along the way to ensure that you mitigate that and manage that as you develop a project. And that's where our investment opportunities lie. So what is our value proposition? What have we done? Well, we've been involved in this since 2013. And we've invested, including into joint ventures and in public markets, somewhere in the region of £25 million. So the investment and £10 million in strategic investment and cash. And our value at this moment of time, basically attributing the share price value of the investments we hold, is around 38 million. But where does the growth lie? Well, the growth lie in the NPVs. And if you look at these projects where we have 20% equity stake in the Sinovac lithium project, there's a NPV there out for us about, assuming it comes to production, this is at a PFS stage, is 108 million. The Sonora lithium project, our equity and our joint venture, they're going to be publishing their bankable feasibility study, is around 98 million. And then we have what we'd like to do. We recently got, we sold some of our Sonora project to do basically what we've done with these two assets, invest early and move it up the value chain. I would love to be able to do something like this again and turn that in fairly short order, 3 to 4 years, into another 10 million, an additional return like that. And I suppose this is the typical lifestyle, and you can see the return, risk and returns, and where our assets lie. These two projects, well, actually all of those 3 projects, we invested around the scoping study area, and we've taken that value move up, and we've got a couple of early stage projects here that we've got at. We've sold some of Sonora lithium. We went with 16%, we're down to 9% on that. We look to take the profits from that cash and reinvest in early stage projects and take that risk out and bring it up to get up the value curve, as we've done with our others. I suppose it's a bit more geography where you can see where they are. The lithium, Sinovac lithium, is in the strategic heartland of electric vehicle development. And that is VW, that is BMW, with VW basically saying the whole range by 2030 is electric vehicle. And we've got a cobalt asset. Cobalt is part and parcel of electric vehicles and batteries. And Sonora Lithium are one of our oldest investments. So, these assets to us are pretty key, 1 and 2, and the rare earth deposit in Australia. All of those are at feasibility or embarking or about to embark on the feasibility studies. So who we are, I think, that sort of speaks for itself, and I'll let you read it at your leisure. But I think you want to understand who we are. We enter projects at ground level. We'll either take management participation, we'll be involved in the management, we'll look at invest inexpensively, early, but understand those risks and try to mitigate them. So we do see often quite a lot of assets, but we choose not to invest in them because, and they're unlisted, because they just have too much risk. We've reviewed all the salars in South America. We did an independent review. We know which ones to go. There's some very interesting ones, but they're quite expensive. And we leverage our skill set. We've been involved in this since 2013. Myself, I've been in the resource game, well, since I graduated. I'm a geologist, and And this is a really interesting space. For us, it's a time that we can capitalize on what we see as an amazing growth story within the electric vehicles in particular. I haven't even touched on energy storage, but there are some great assets out there to be looked at. I think I'm going to call it a day there. I'm almost bang on time. If there's anything else.
Kiran, thank you very much. Very nice. Come over this side.
I'll go over there. Shall I?
Do you have any questions for Kiran, please? Anybody? Gentleman at the front here. Thank you.
Yeah, Kiran, you're mostly in lithium projects at the moment, but as a minerals company, you had said you're more interested in the strategics overall. So what kind of projects are you looking for at this point, or commodities-wise?
So we actually, it's almost by default, but we got involved in a cobalt project in the Czech Republic. So cobalt and lithium are pretty much part of the key elements in battery technologies at the moment. Although nickel, I mean, the reality is electric vehicles will take up copper, will take up nickel, will take up all of these, actually some base metals along the way. At the moment, we've focused on lithium, partly because when I talked about exploration space, it's not that no one's not known about it, it's that there are more opportunities to find mispriced assets and invest in them and provide value.
I think a gentleman here.
I think that's part of the answer, but is there anything that can act as lithium can do at the moment or in the future, do you think?
I think most people will say the answer is no in the very short term. I mean, lithium-ion batteries became commercialized in 1990. First used, I think, on the Moon Rover the Moon Rover exploration vehicles. But they've been around since 1990, and their cost curve is probably their biggest barrier to entry. You're going to have to get past that whole cost curve to get down to $150 a kilowatt hour to be competitive. There's actually a really good example of why sometimes not the best technologies win out. It's actually these flat screens. There was the development of tiny cathode ray tubes, which, as we all know, cathode ray tubes are much better at contrast and all the rest of it. But because these came down so quickly and they've not been able to be competed against, it was abandoned. It was a $300–400 million investment by Panasonic, and they just scrapped it. It was a better quality product, but just could not be on cost. And the EV revolution occurs because of the cost imperative, not because it's greener, because it's cheaper.
Lady at the back.
Are you likely to do anything with the share structure where now, like, you have to get hundreds of thousands of shares for even a little bit of money? So you have a big board.
Yeah, so I think we do suffer slightly from the curse of an AIM company that's been around a while. I think this was originally a music publishing shell or something to that effect. And so, yes, we have a lot of shares on issue. I think the experience that and the evidence suggests, I always go back to evidence-based understanding, is that when you do a consolidation, which is what you're talking about, without a transaction behind it and a substantial transaction, what happens is that you tend to see a drift down in price. Because perceptionally, people feel that it's easier to get from, let's say, 1p to 2p than £10 to £20, even though the market capitalisation is the same. So all evidence suggests as soon as you start to consolidate, for no reason apart from what you're saying, you're not going to create, you'll have a further deterioration of your share price.
Gentleman here, please.
Your charts seem to suggest that there's a possibility of a big imbalance between the demand for electric vehicles and the availability of lithium to supply them. What do you see as the likely effect of that? Is it that the price of lithium goes through the roof and holds back the development of electric vehicles, or that the demand produces an awful lot of dodgy production of lithium, shall we say,
So dodgy
to fill the gap?
Yeah, so dodgy production or dodgy lithium is not going to occur because you've got to understand it's a product, and we just saw the issue that we saw with Samsung and their batteries blowing up, right? Now, I'm not saying that was lithium components, But you cannot have that, otherwise you destroy the brand. You cannot have electric vehicles blowing up in any formal manner. So when you go through producing the lithium carbonate, battery-grade lithium carbonate, if that is your product, you will commission your mine, you'll have what they call a volume offtake, and then after that, there could be, depending on your off-taker, between a 3-month and 12-month period before they'll sign off on battery-grade material, because they'll put your material for production from your mainstream production line through every test imaginable. They'll put it in an electric vehicle and run it for 100, 200,000 miles. So quality, I don't think is going to be an issue. We will probably see demand supply. If there's that gap, you're going to see either a rapid investment, and when we look at the development curve, it takes 10 years to get there, a very rapid investment, a lot of capital flowing in to put new projects online. And then I suppose you could get issues with delayed project implementation, not going up to capacity, poor engineering. But more likely you will see a pricing differential occur. And then the next question, well, that makes it very expensive. Well, lithium is actually, I think it's about a 6% cost base of a battery, so it's actually very small. And then that's probably about a 1 to 2% cost base of an actual electric vehicle. It's, how would I put it? It's the bubbles in champagne. It doesn't cost much to put in there, but it's not champagne without it.
So the likely answer is there's going to be a lot more people working to produce lithium.
Yeah, I think it requires that investment because, and it requires that investment on a vertical integration, because I think what we're seeing, if you look at the debt equity funding of a lot of these projects, they're not being funded by traditional bank finance that you saw with copper and as resources before that, because it's not a commodity. They can't forward hedge out their position. So they take a very much more conservative. So you're going to see a bit more expensive financing coming into these projects and from non-traditional sources. In fact, if you look at all the ones that finance, there's sort of quite a lot of equities funding it. You know, it's not a 30-70 equity debt ratio, it's 50-50.
So are the big mining companies not investing in lithium production?
There is not a single mining company involved in lithium carbonate production. It's all diversified chemical companies. It's FMC. They make, I think, what did I see them making? They make those gangway planks that go onto planes. They're a diversified industrial. SQM, until about 3 or 4 years ago, 12% of EBITDA was lithium carbonate. The rest was potash and other industrial chemicals and Albemarle. Those are the three guys. They're not miners. They are diversified industrial chemicals. The big guys probably there are SQM. They're doing the most proactive. So they are being more proactive. They've gone into joint ventures, into other assets. They've bought hard rock assets. They've gone outside Chile, partly because of the constraints that the Chilean government's putting on them.
Are there any currently producing assets that they could increase the scale of quickly?
Yeah, so that production curve that you saw where I said current production was going up like that, those are those assets. In particular, you would probably look at Albemarle's Greenbushes is going to be a big one. I mean, that is a world-class deposit in terms of grade and size, and that has got the ability to expand. But just because it's got the ability to expand the resource, it may not occur on time, right? But yes, there is increased production occurring across and that's a large chunk of that supply curve moving up.
Any more questions, Kiran, please?
Have you looked at any graphite projects?
I have looked at them, and I'll be honest that the market's a bit more opaque in the sense that a lot of the graphite seems to be used in the high value, I think it's big flake, large flake graphite, is not being used in batteries. It's being used in fire retardants and such. So, I mean, getting your head properly round one opaque compound, lithium, is hard enough. And I think we've really focused on lithium, and then probably something we're a bit more traditionally know about, you know, cobalt, copper, those sort of things, which are traditional commodities. So we've focused on lithium. I'm pretty certain that's where our primary focus will be going forward.
Just ask one more question.
Yep.
You sold a big chunk of Bacanora at a price that, I don't know, surprised me. Can you make some comments on that, please?
Yeah, absolutely. So do you know what the volume weighted traded Bacanora shares is per day?
It's pretty low.
$30,000-$40,000. Yeah. So the thing is, there was a decision to be made, and you know, you saw the various announcements that we went to the institutional investors, then went to a strategic investor, eventually sold to institutional investors. So you know, for us to at the end, we're an investment company. We do need to liquidate positions and exit out those positions. For us to dribble that onto the market would have been far more detrimental to the Bacanora share price than selling in one block. So when we were looking to sell that block, we looked at those offers, and those were the offers on the table. But if you also looked at, and typically when you're selling those blocks, I would say that yes, it's a deeper discount than we would have expected. We were probably expecting a discount in the region of about 8, counted as a secondary placing, about the 8%. And it turned in to be more like a 15% discount to the market. It's not what we wanted, not what we, not what we desired at all. But I don't think it was ever going to be a premium. It wasn't going to be at the market. It was always going to be a bit of a discount. So it was the market that offered. Effectively, I think I worked out it would have taken us 200 trading days or 300 trading days to exit out of that amount of the position, not any other anymore, at trying not to affect the market. So trading less than 20% per day of the average volume. So it would have been really difficult, and I think it would have been more of a pressure because everyone said there's an overhang. We've now, that's it. We're now balanced in our portfolio. We've got some cash to reinvest, and our view is certainly for the foreseeable future, we are strong supporters of Bacanora.
Okay. Have we had any more questions, gentlemen here? Peter?
Sort of two elements. One is about Bacanora, because it wasn't that long ago you tried to buy it all. Mm-hmm. And I wonder what caused the change of strategy. And secondly, in general, what are the criteria for exiting an investment? You've got half a dozen live things going on at different stages. Are you waiting till they get into production, or are you waiting until they're in a position to seek a big development partner, and that's the time you move on?
So the first question was about, yes, I was segregated from that whole involvement because at the time I was on board of Bacanora, and a confusing time in my history and everyone else's board history, but I was on the board of both companies. So really that was the rest of the board looking to make an offer. They made an offer, and I think there were some underlying aspects within that, probably the redomicile issue, that sort of made Bacanora and pricing reject it. So, the whole idea is that sort of discussion is meant to happen privately. We were advised by SocGen and Hanneman Partners, some of the best advisors out there, and it just didn't happen. I would probably say that that's part of the confidentiality, and don't want to really elaborate much more on that. So the exit strategy, well, I think there was a slide 3 or 4 back there. I don't know how I can do that. If you can go back. Further back.
You've got the...
Oh, I need it, do I? Sorry.
Oh, there we are.
There we go. So when I look at, and that's a pretty long time, so it's construction and commissioning, but we look at the value. The biggest value for us is in this area here. We have to be careful if we've got these big stakes when we exit, because we don't want to affect the market as a whole. Our investment is here because this is what we understand. These are controllable risks that we can manage with management. When you get into these areas, you start to get into what they call, there's another line that should go here, which basically goes like this in terms of corporate risk. There's the risk of financing, the risk of construction and commissioning, delays. So our expertise really lies within this period to invest and develop it and help develop it on. In fact, all of these assets were over here, well, around here. So our exit will, it is about return. We measure on if it's stock, we'll measure on the basis of how much we paid for that individual block of stock against how much we're selling it for. And we want to make those returns. If we don't make those returns, fundamentally, and we just stay invested, our next port of call is the shareholder to raise capital for new projects. And I think this time we thought certainly the profits that we made from that investment, we'll be investing a part of it and hopefully all of it into new projects.
Okay, thank you. And one final question. Yes, sir?
Yes, good evening. I'm a shareholder in Cadence.
I've been a shareholder for some years since you were in your original name, Rare Earth Minerals.
Yes.
I don't really know why you changed the name, because the Rare Earth Minerals tells people immediately what you're doing. Cadence does not. You have to go to the dictionary to get an explanation and possibly understand. The other thing I noticed, when you change, I've been a shareholder since the price was almost 2p,
Yep.
which you had a valuation of almost £100 million.
Mm-hmm.
Very valuable. The price has gradually dropped to, I think, 0.39, it closed today, 0.4. And I noticed that since you changed the name, this has increased. I mean, there was less volume being turned over on the stock market every day. And I think it's because people didn't understand what was going on. Can you sort of speak a little bit about that, please? Because
Well,
as shareholders, we'd like to see the price go up.
Yeah, as shareholder, I want it to go up. I'm also down about 40% on my investment. REM, or rare earth minerals, lithium is, our primary thing is lithium. Lithium is not a rare earth at all. It's sitting on this side of the table, so it's definitely not a rare earth. And it was a hark back to Yangibana. We have Yangibana, but so it was showing a focus and a change. And we didn't want to call it Lithium X or LI25. So basically the idea was to cadence and basically in rhythm with the revolution that is occurring. Get it? Revolutions, cadence in rhythm with the revolution that's occurring. Now, I don't think a name change simply affects share price. I think there are two factors that have been affecting our share price, which are fundamentally there was a level of overexuberance where if you looked at our asset base, we had Sonora, and we had, I think, about, let's call it 10% at the time. It was valued X million. We then had the JV, and there was this very large premium, and I think I had in an older slide about £60 million premium over and above that. What has happened since then is that's narrowed, and that's narrowed to effectively what we showed just there and gone a bit further to the asset base. So what the market is doing, oddly, is valuing us pretty perfectly. They're going, what is the value of your EMH shareholders? What is the value of your BCN stock? And what is the attributable value of your cash flow from your JV? Which I sort of set out a bit earlier on. Not quite there, but... and they're valuing it there or thereabouts. So, what we've been trying to say is, how do we change this paradigm? How do we move this forward and get up to where management is incentivized and has to earn in to do so, to get up to prices above 2? How do we do that? So we do that by doing what we've done beforehand, taking the profit certainly that we've made from the sale of Bacanora, reinvesting it. Now that might not, and it probably won't be in a public company, because otherwise we end up in the same trap. We want to invest in something that we've got enough experience and take a very large stake for not much money, right? So we want to be looking to taking stakes of around the 49% stakes, where I said there's plenty of exploration space out there to look for new assets, and that's what we're actively doing.
Very good. Kiran, thank you very much indeed. Thank you, everybody. Thank you for coming.